What's up, guys? Welcome back to the channel, Mark Stock Review. Hope you're doing well today. This video is going to be on Exela Technologies. I'm going to be going over some price targets and buy ratings. I'm also going to be going over a brief overview, some pros and cons, and then a final take. It'll be a quick video and to the point to respect your time, so if you do find it helpful, please consider subscribing if you haven't already, and a thumbs up would be greatly appreciated. That said, let's get right into it. Every source that I checked during my research had a buy rating and a price target of $1.55. However, note that the price targets seem to be coming from only one analyst, so that could mean that most analysts are essentially ignoring Xela until after they clear the NASDAQ requirement. And if that does happen, that's going to mean more price targets, meaning more attention to the stock, which ultimately could push up the share price. But for now, the potential return from that $1.55 price target is a healthy 89%, assuming the current share price is around 82 cents a share. Exela Technologies is a business process automation company. They're multi-industry, but note that most of their revenue comes from banking and finances and healthcare. Their focus is workflow, cognitive automation, digital mailrooms, print communications, and payment processing. And their niche is their ability to connect two massive automation systems. One of their major products is Digital Now. They're a suite of digital solutions on a cloud-based platform. And their other major product is Xela Smart Office. They're a suite of interconnected workplace technologies and services designed to enhance employee and visitor experience, optimize space and energy use, and streamline daily processes. And before I move on, full disclosure, I do not currently own Xela at the time of this recording. Since my last video, I've added to my position in VGAC and started a new position in GXGX at 1040 a share and a new position in ROCC at 1045 per share. Any questions on those, just let me know in the comment section below. The first pro I want to talk about is that they're focused on divesting. As an example, they sold their tax benefit group, which resulted in proceeds of $38.2 million. For them to be successful, per this graph, they need to continue divesting where appropriate in all areas except banking, finances, and healthcare. Some general benefits of divesting are listed below. I'm not going to read them all to you. However, in aggregate, they can improve shareholder value by eliminating unprofitable segments and reallocating assets to new areas of growth. Pro number 2 is that Xela has demonstrated their ability to improve their liquidity. On January 15th, they announced a 5-year, $160 million agreement to improve liquidity with an initial 5-year term with the possibility of that term being extended. And again, I listed some of the benefits below. I'm not going to read them all except to mention that it does decrease the likeliness of future capital raises. And so from my point of view, the combination of divesting and improving liquidity should make them a much more attractive acquisition target if that's the route they want to go. And pro number 3, they were granted an extension to regain compliance with the NASDAQ requirement for a minimum bid price of over $1 for a minimum of 10 consecutive days by February 8th, 2021. But it should be noted, the look-back period will be starting the week of January 25th, and the current share price is still under $1. And as many do believe the share price will hit $1 by that point, one thing we probably all can agree on is that there's going to be periods of extreme volatility. Just as I'm recording this video, the share price went from -2 to +10% in really just a matter of minutes. And as the final pro, I want to mention a couple of their financial bright spots. Those being their capital expenditures as compared to revenue in Q3 was down actually 0.1 year over year, and their net losses in Q3 2020 was $28.3 million as compared to a net loss of $131.3 million Q3 2019. And to be fair, I did want to add some cons. Number 1, the combination of being a mature company and unprofitable. A company that's unprofitable needs high revenue growth, and the 7.1 revenue growth over the last 3 years needs to be better. And number 2, they have 21,000 employees, but most of the revenue is only coming from 2 segments, so it's going to be challenging but not impossible to divest and reorganize in order to create shareholder value. My final take is that this is definitely a high-risk, high-reward stock. I think if they can get through the NASDAQ requirement, they're going to be attracting a lot more institutional and retail investors and professional analysts, and at that point, I believe there's going to be a lot of money to be made. That does it for the video. I hope you guys found it helpful. If you did, please give it a thumbs up. It'd be greatly appreciated, and subscribe if you haven't already. Hope you guys have a great rest of your day, and I'll be talking to you soon. Take care.